Good morning. Welcome to today's program. This is Andrew Wilkinson, Director of Trading Education at Interactive Brokers, with my esteemed colleague, Jose Torres, who's our Senior Economist. How are you, Jose? Good morning.
Good morning, Andrew. Doing well, waiting for this CPI wide range of potential outcomes. The minimum expectations at 2.5, but the max is at 2.9, median is 2.7. Top of mind is how is the BLS going to handle the shelter calculation after that really pulled the number lower to a huge miss in last month's report, down to 2.7%. What was expected was 2.9. So we could have a significant beat to the upside or a significant miss to the downside. And, stocks are off of an all-time high yesterday. And today we're seeing yields climb. 10-year is back up to its resistance at around 420. That's being pushed higher by news out of Tokyo. Prime Minister is looking to get some of her stimulative policies enacted. So that's really driving somewhat of a sell-off in global bonds, particularly at the long end. And yeah, we're going to be here talking about the numbers. And thank you all for joining us. And we'll also be answering your questions. Of course, yesterday was a significant market day. We saw that there was an investigation launched into Chair Powell that then the president said he didn't know about. So presumably there's still some pressure on the central bank to lower interest rates. Of course, this report could inform that path, particularly with yields, here at a resistance point. So we'll see what happens. The Russell 2000 has also been performing really well. The Dow Jones, we've seen a broadening in the market, more sectors participating. Mag 7 hasn't really been the primary driver of gains. It's been more of a spread out kind of space.
Yeah, the bifurcation in the market's been pretty encouraging, really, hasn't it, Jose? I think let's just wind a bit back. You said a lot there, Jose. It's a very good introduction. Let's just set the frame for today's December CPI report. The last time we were here talking about inflation pressures was hot on the heels of the government having reopened. So there were a couple of strange things in that report, right? The way that they dealt with shelter cost, you were telling me a moment ago. Just explain how important that particular category is in the overall consumer price index.
Absolutely, Andrew. So as most of us are quite aware, housing, shelter, whether it's a rent, whether it's a mortgage, it comprises a huge chunk of the average income. So because it comprises a significant share, it also comprises a great share in the consumer price index, in the CPI. So whether that's hot or whether that's low, that can meaningfully impact the number. It's north of 40%, around 44% or so. So what the BLS did is essentially use a carry forward technique, essentially assuming that the numbers from August and September were the same in November. So essentially zero month over month. And that served to pull the number lower, particularly core, which came in at 2.6% last month. So that's really what happened. So that's controversial because shelter is usually not a donut. It's not zero month over month. On the low side, it's 0.1, it's 0.2. I'll pull up a chart on that now.
So is there a likelihood that the November report will be revised here specifically with respect to that 40% weighting?
Probably not, gauging from the Bureau's past policies and how they handle things. Here, share my screen for you all.
And I think one of the overriding factors right now, Jose, is that the short-term trend is lower, isn't it? So this is an encouraging. It's an encouraging time for investors. The main report, I would still say, and correct me if you disagree, I think the main report that we're looking at is the employment report, right, which is coming real soft. So if inflation goes the wrong way, I still think there's probably going to be more emphasis on the labor element of the Fed's dual mandate, right?
I think so. I definitely think so, especially with the unemployment rate. Being a little volatile. It came down last month to 4.4%, but it's been quite volatile. There's been expectation that the labor market is firming up, but still, I'd agree with you that that the labor side of the mandate is going to take priority. And it's to illustrate sort of where we started with inflation in the beginning of the year. January 2025, we were at 3%, and we started slowing down to 2.3% in April. We started inflecting higher, back up to 3% in September. We have this blank in October, folks, due to the shutdown, and then we came down to 2.7%. When you look at shelter here, this is a five-year chart of shelter. We haven't been zero in shelter, not even since September 2020. We've never been down at zero. So essentially, let's go back. Yeah, during COVID, we were in the months of March and April, we were at zero. But usually this, as you can see, folks, this number is never really at zero. Housing costs and rents, they tend to go up with time or in a combination. So the fact that that carry forward technique brought this contributor, the significant contributor north of 40%, folks, to zero, that really pulled the number down. So we're going to be watching shelter, and whether there's another zero. Some people think that it's an accurate representation of the data because of immigration restrictiveness that has put downward pressure on rents, and household formation is also down. So we know the housing sector from a transaction sales perspective has been particularly slow. So there are some arguments that are supporting the lower shelter readings. I just think that it's more realistic to see a 0.1 or a 0.2% month over month. Zero is just something that I'm not used to seeing as an economist.
So let's think about other inputs here into the consumer price basket, Jose. Gasoline and energy, those prices have been particularly well behaved in the last 3 months, haven't they? So isn't that another kind of semi-threat that's not likely to show rear its ugly head for some time?
Yeah, and that's been a huge win for the administration in terms of trying to manage the risks of tariff-related inflation with energy deflation, right? Because you can have a tax on imported goods, but if transporting those products all of a sudden is cheaper, then you have an offset there. So that's been a huge driver of the normalizing inflation that we've been seeing throughout the year, albeit we'll see today if the number is closer to 3 or closer to 2.5, which is going to be quite significant.
All right. Now, geopolitics in the background is playing its role. Obviously, there was the situation with Venezuela that's culminated in a meeting at the White House on Friday with CEOs, senior executives of the major oil companies. But we've also got this dreadful situation in Tehran, in Iran, where the administration is ruthlessly killing protesters against the regime, and President Trump has threatened but hasn't acted on doing something there. And then there's well, with that backdrop, Jose, how are investors feeling?
I think investors the Venezuela situation is curtailing the potential for an energy price spike. So I think, and for quite some time, geopolitics hasn't really been that much of an influencer to stock market returns. So I don't think that, investors right now there's a pretty high bar for geopolitics to begin to affect investor psyche, especially against the backdrop of President Trump really a lot of times commanding the headlines, and sometimes a lot more bark than bite. Of course, that's part of the political dance. That's part of the theatrics. So I think that, until there's something imminently occurring, folks aren't really too worried. That said, the market, it has been making new all-time highs in broad-based fashion, but it's been really a grind higher. It hasn't really felt like investors are super confident. Valuation concerns seem like bringing some buyers to be, reducing their size, and they're getting in there. And there is some short selling going on out there. There's folks that think that maybe after 3 terrific years, 23 and 24, around returns around 24%, and then last year returns around 16%, so way above average. Some folks think that 3 years on, 1 year off. So that's something that's on folks' mind. 2018, negative year, 19, 20, 21 positive, 22 negative, 23, 24, 25 positive. So maybe now it's negative. So, that's for what it's worth.
And then the other thing, the reason I paused the question is I wanted to treat this one separately. We've got the big issue with the Justice Department having a go at Fed Chair Jerome Powell. That has the potential to be to create significant waves, I'd say, for the market. And you're seeing that. What are you seeing in bond yields in response to this move?
Yeah, the duration has been higher, but I think if you look at the 10-year here, yeah, the 420 level on the 10-year has been the resistance point. Like we said, it's been that for quite some time. Since early September. So really not a huge effect at the long end. We saw the dollar, however, the dollar dipped yesterday a little bit. We see this dip here from late November, we were up above 100, and then we dipped down to 97 or so. So we've had some volatility in the dollar, but really the big move, folks, has been in precious metals, and we only have a few seconds before the CPI comes out. But precious metals have continued to rally strongly. Silver started the year around 71. It's at 86. New all-time high today for silver, by the way, folks. For gold, not an all-time high, but still a great year so far. Started the year off at 43.08. Now up to 46.01. Got to as high as 46.30. So that's really where we've been seeing the moves. The store of value bids are lining up in the precious metals space.
So here's the order of play, Jose. About I don't know, a few seconds to go. Should be out about now. Jose is going to have a quick look at the report, and I'm going to have a look at it too. So continue. January the 13th, I'm seeing 0.3% on a seasonally adjusted basis. All items increased 2.7%. Index for shelter rose 0.4% in December and was the largest factor in the all items monthly increase. The index for energy rose 0.3%. So 2.7 looks like unchanged. Looks like food costs at 0.7% were quite high, with an annualized cost of 3.1% higher. What's your immediate take on it, Jose?
Yeah, well, this is quite a significant report, because off of a 0.4% month over month in shelter, you'd expect the year over year number to be a little higher than 2.7%, because 0.4 is quite strong. But it appears that the zeros from the previous months, from October and November, notice that these are blank. It seemed that served to lower the base effects. Really, we saw relief in used cars and trucks. We saw relief in gasoline, down 0.5%, but really broad-based price pressures everywhere else. Food at home and away from home, 0.7%. That's quite significant. But the year over year on food away from home is 4.1% versus food at the supermarket, 2.4%. So that's really reflecting business costs and wage pressures in the labor-intensive space. Transportation services, 0.5%. So yeah, it's interesting how this broad-based increase across the board only landed us at 2.7%. It seems as if October and November's numbers were understated. That's really where I'm at this point, Andrew.
I'll
keep looking.
Looks like the March S&P future has gone from about 9 points negative to 18 points positive, and looks like the triple Qs are now up 0.3%. So gains of about a quarter to a third of a percent across the board. Small caps, the IWM, Russell 2000, up with gains of twice that, so 0.84%. So that's going to be another all-time high for the small cap index. Jose, why small caps feeling the love in this market so much?
Oh, because small caps are experiencing the beneficial combination of rate cuts and a re-accelerating economy. You look at Atlanta GDP now, it was up to 5.1% a few days ago. There's expectations that the tax package from 2025, alongside other measures and some fiscal stimulus designed to bolster the constituency's confidence in the current administration, that's really going to help economic activity in the short run. You mix that with rate cuts, and that's perfect for small caps, because not only are they cyclically oriented and they need a growing economy to grow revenues to a greater degree than large caps, but they also have vulnerable balance sheets. So when the rates come down, when you have rate cuts, those interest costs decline, and immediately you have expanding margins. Earnings expectations for the Russell have been particularly strong. And it's with this kind of backdrop, it's very possible that the Russell can deliver the kind of returns that the S&P and the NASDAQ have delivered in the last few years, maybe 20, 25%. If you look on a 5-year chart, the Russell, it's only a few percent above its 2021 high in November, when the IWM was at 244, 245. Now it's at 261. So hardly the amount of progress that the large cap indices have had.
Well, so from there, would you say that they have more room for the upside, or that it's still a challenging environment? It looks to me like an extremely bullish chart there, but you sound a little cautious.
No. No. I think we're bullish. I think on the IWM, definitely bullish. I think just off of the years of underperformance, it seems like right now this is the perfect backdrop for it. In terms of a sustainable 5 or 10 year run, that's that depends on if the Fed is going to turn around and hike. Folks, yesterday we got some research notes from some providers out there, and folks are penciling in hikes in 2027. So that wouldn't be good for the Russell 2000.
When's the next election? 2028. Not good to go into an election with a rate hiking cycle, is it? So Jose, overall, you're seeing, so it seems to me like there's a big sigh of relief in the stock market, and in the bond market, yields are coming down, like 2s and 10s are both yields coming down about 6 basis points by the looks of it, 5 or 6 basis points. So like a horizontal decline in yields. There's no bias to a steepening or a flattening curve today. So, but you're seeing pressures under the surface here a little bit.
I mean, you're right. It is pretty even, but there's a little bias on the monetary policy sensitive shorter tenors by about 1 BIP, which is not much, but there's a little bit of a bias. So you're getting a little bit of a bull steepening. Yeah, I mean, let's look at the ForecastTrader and let's see what the Fed decision odds for January are, because they became pretty much. So January is still. So here we have a 43% chance, essentially, that the Fed will be at a midpoint of 3.375. So this means a 43% chance of a 25 basis point cut by March. So that would really play into.
But not January.
No, not January. January is at 4% odds of a cut.
4% odds of a cut, right? So you pay 96 cents and you get paid out $1 if the Fed doesn't change anything. Okay. What about what are we seeing for, say, the end of this year? Where does the rate, if there's a likelihood that the market is now pricing in interest rate hikes in 2027, what does inflation look like according to the forecast trader by the year end here?
Okay,
Always the turning point. And to the audience, please do send your questions on X, LinkedIn, and YouTube for us, and we'll try and get to as many of those as we possibly can this morning. So, all around, just to recap, we've had a fairly healthy report. I think right in the middle of expectations. It was unchanged on a year-over-year basis compared to November. So we've had a 2.7% increase in consumer prices, and the lowest expectation at 2.5 was not met. But then the fear that the market will not realize with a 3% gain either, or 2.9% gain. So pretty healthy gains for stocks at this point, and bond yields are lower, which probably feeds into higher equity prices. Jose, take it away. What have you got?
Yeah, I mean, we're getting a little bit of tempering in the initial bull rally. We're up only 14 bips now in the pre-market. We have some other economic data we're going to run through real quick. So the ADP employment report, this is essentially the 4-week moving average of job growth. So that increased to 11.75 thousand. That's per week. So that equates to roughly 48,000, 50,000 jobs per month or so. So that's a little bit of an acceleration. That's, we had some losses in this indicator in the past few weeks. So the fact that it's starting to build and reaccelerate, even if it's, a small number, it's still positive. We spoke last week about all the constraints that are weighing on the job market. Small business optimism came in above, in line with expectations, 99.5, above prior months, 99. That was November. When we look at new home sales, will be out later. That's what we have for now. One thing, hold on, folks. Core inflation came in below expectations. We didn't talk about core inflation, 0.2% month over month and 2.6% year over year. So that is also a huge determinant in what we're seeing in the positive response in treasuries and stocks alike. Essentially, the core segment of the gauge is a better longer-term trajectory of cost pressures. So the fact that it's still at 2.6% is very, very good. That means we're in the mid twos, and with a few basis points lower, call it 30 or 40, down to 2.3 or 2.2, folks. Now we're right at the Fed's target. So, that's something to watch. That's particularly critical.
What do you think moves the needle in favor of a rate cut in March, Jose, between now and then?
I think if you get this headline and this core down below 2.5 by then, that's a little bit of a short window, or you have some weakness in the job market, which I'm not expecting, then you could have March open up. But I think June is going to be more realistic, folks. I don't see March on the horizon. It seems like it's too soon. And then also now, sometimes the political pressure, sometimes it burdens the decision-making process, because now Chair Powell maybe is thinking about, is he cutting? It's bias. Is he cutting due to political pressure, or is that affecting him in any way? So sometimes, believe it or not, political pressure could lead to an increasingly hawkish Fed, because the central bank perhaps doesn't want to appear as if it's bowing to the White House.
That has just gone off the top of my head here.
Do we have any questions?
We got no questions at this moment from the audience.
Let's go to Steve real quick. We'll take a 46-second break, and we'll be right back with you all, folks.
Hi, I'm Steve Sosnick, Chief Strategist at Interactive Brokers. Where do you think inflation is going? Do you see a recession ahead or more growth on the horizon? What's your prediction for the Fed funds rate? Right now, 73% of traders expect it below 4% in December. What's your forecast? Interactive Brokers forecast contracts let you turn insights into action. Buy yes or no contract on ForecastTrader and earn $1 for each correct prediction. We invite you to explore the data, spot the trends, and make your call. Start forecasting today at ibkr.com/forecast. The best informed investors choose Interactive Brokers.
All right, folks, we're back.
What are the chances, Jose, that that with the pressure on Jerome Powell, assuming that investigation continues at the Department of Justice, what are the chances that he just says, right, I'm not going to do anything? Well, I don't think the committee should do anything until we see further progress on inflation.
We've seen an episode like this back during President Trump's first term, around the 2018 area. You know, we saw the quantitative tightening coincide with a Fed that didn't want to reduce rates that much. You know, the Fed has reduced rates quite a bit. You know, they've reduced 3 meetings in a row in September and November and December, albeit not as much as the president wants. The market has done great. Financial conditions have loosened. You know, so, you know, it's a question of the president wanting more. Of course, Fed Governor Stephen Miron has made the case to go a lot lower. Others have been hawkish. So we have a really divided central bank at this juncture. I think Chair Powell is he takes his job very seriously. He's going to continue to analyze the data and work with the committee and set the interest rate as it provides the maximum benefit to the American financial system and to American society. You know, so I think that that's what he's going to focus on. His term is ending in May, so the significant impact there will be if he stays on as governor or not. Of course, there's also that pending investigation with Governor Lisa Cook as well. So, you know, we'll see what happens, but it's definitely looking like it's going to be quite interesting and quite volatile, you know, as we move on.
The other interesting piece of the jigsaw puzzle here, Jose, is that last Friday, the Supreme Court was due to rule on tariffs, the legality of tariffs, and for some reason they delayed it. So it may come out this week, it may not. But that's been one of the concerns at the central bank and amongst economists like yourselves as to how much of the imposition of tariffs is weighing on higher prices for consumers. What would the impact be if the Supreme Court rules that these tariffs are not legal and that the president did not have the right to impose them?
Well, you know, first top of mind is what is the president going to do in response to that? Because the administration is already looking for other ways to impose tariffs in case the Supreme Court rules against them. But on balance, if the tariffs go away, then that's a short-term bump to the upside for corporate earnings. That's be strong. It would be better for balance sheets, but it would be bad for the fiscal situation from a budgetary standpoint. Great from a stimulative perspective, because that'll unleash a strong amount of fiscal dollars back into the economy. But we know that the numbers have been particularly high, over 300 billion or so in the last since the beginning of fiscal 2025 up to the end of December. So that's really helped to cushion the budget deficit and has helped to curb long-term bond yields alongside the contained oil prices. So, you know, if you do get that halt, that'll be bad for fiscal and also bad for the onshoring ambitions. You know, manufacturing employment, we lost jobs in manufacturing last year. Of course, a big theme of the administration going in was to revive the manufacturing sector. The tax policies passed in 2025 alongside the tariff measures are intended to bolster that sector. So, that would really weigh on onshoring ambitions. On the other hand, if the Supreme Court allows the tariffs to continue, then that, corporate earnings expectations are already buoyant. So I don't think folks will be too upset from an earnings standpoint. I think it'll be good for the fiscal situation. I think that'll bring us to a flatter curve, and I think it'll bolster the onshoring ambitions, increase manufacturing employment somewhat, but investment would also be very strong. Investment has been strong. It's just that the orders, the transactions, and the jobs haven't been. They've been weak, but the investment has been very strong.
But there's also the potential that this might take away the baton or the stick that Trump has been using to beat countries into submission, or at least attempt to. Yesterday, that anybody who does business with Iran will be subject to a 25% tariff. So if China imports oil from Tehran, then all of their goods are going to be subject to a 25% tariff. If the Supreme Court says that's illegal, right? Well, what are the implications there for Trump and his international policy?
Yeah, no, I mean, President Trump would be weakened. That'd be one lever that he wouldn't be able to pull, and it's been quite a significant lever. The U.S. has the largest economy in the world, and a lot of folks depend on our purchases. So it would be a significant lever that he would lose if the tariffs are dismantled. But, one thing, when you listen to the Supreme Court arguments from the conservative justices, what they said was that they were concerned with the broad-based implementation of tariffs on countries like Spain, countries like France, countries like Portugal, that don't necessarily have a hostile relationship with the US, right? So I think that there's a good chance actually, that the Supreme Court strikes down the tariffs in broad-based fashion. However, allows those nations that have a more adverse relationship with the US, allows those tariffs to continue. For example, Havana, Tehran, Moscow, Beijing, nations that have a history of tension with the US. Maybe with those nations, the US can maintain its tariff policy.
I could dig into that one. I'm not going to at this point. All right.
Well, I think what will stay in my mind for the rest of the day was when you said, beat them into submission. I think unless you have any other content, I think we're good. We're past the 30-minute mark.
Well, I was going to ask you about the contract there's two contracts I want to talk about. One for the Supreme Court denying, ruling on Trump, ruling on tariffs, and the other one was the odds of one of the Kevins. What are the odds of the Fed nomination at this point?
Sounds good. Here we go, folks.
So this is, will the Supreme Court, go ahead.
Sorry, you go ahead, sorry.
Will the Supreme Court uphold Trump's tariffs by July 2020? I can't read the date.
This July, in 6 months.
This July, okay. And the odds currently are, I can't see them.
29%.
29%. So that's been pretty low for the last couple of weeks now. Okay, and the Fed nomination. I'm wondering whether there's been any change in the odds there, given what the Department of Justice announced over the weekend towards the criminal case against Jerome Powell.
Real quick before we get into that, just the Supreme Court was as low as 21%, made it up to 36%, and today it's traded as high as 32%. So we've seen some increase. Probably the delay in the decision is having some folks consider whether the Supreme Court is looking for a way to allow them. So that could be reflected here in the higher price. And now let's go to the Fed chair contract. So we have Warsh at 39, Hassett at 37. And then Waller, Judy Shelton, and Michelle Bowman at 7%, 2%, and 2% respectively. So both Kevins are neck and neck. Hassett took the lead yesterday. Warsh is back in the lead today, but really marginally, folks. These two are neck and neck at 39 and 37.
Okay, that's probably about the show then.
Well, thanks so much for joining us, Andrew, and ladies and gentlemen, thanks so much for being here.
All right, and I guess we'll see you in February.
Yes, and then the Latin American audience, we're going to have a Fed decision day at 3:30, so a little bit of a different time for the Espanol folks. We'll be talking at. Please hold on. We have one question here. Please comment further on the perception that the administration wants to devalue the U.S. dollar and central banks are buying gold and silver. I don't think it's from Martin. I don't think I think the U.S. doesn't necessarily directly want to devalue the U.S. dollar, but the policies that it's pursuing is essentially leading to a weaker dollar. When you consider the fact that we want to cut rates significantly, from Washington wants the White House wants to cut rates significantly, and inflation, inflation is not too hot, but it's still way above target. So that's something that's weighing on the U.S. dollar. If you look at a chart back when rates here were zero, that's back during the COVID stretch, the dollar was a lot weaker. Central banks are buying gold and silver. Those are, store of value bids. Essentially, when you own currencies and you own sovereign bonds, sovereign fixed income assets, you're really subject to what those central banks are doing. And there is a general sense internationally that a lot of central banks are letting inflation run hot and are turning from being currency defenders to prosperity stimulators. So that whole dynamic is leading folks to central banks specifically to want to buy more gold and silver. And that's been really the fundamental foundation of the rally. It's also been aided, however, by geopolitical tensions and the need for safe havens. Now, safe havens, you used to find them a lot in treasuries and in government issued assets. That's traditionally where you'd find safe havens. But because of what I just said, with the central banks a lot of times choosing the path of least resistance forward and not necessarily embracing much monetary discipline overall, that's really driven bids for gold and silver. One more thing on the U.S. dollar. Why is there a bias to lower? Because when you have a weaker dollar, then your exports to other nations become cheaper. And, President Trump and the administration wants to bolster the manufacturing sector here. So if the dollar goes down, then Beijing, Mexico City, Barcelona, all the countries around the world can increasingly afford, to a greater extent, American goods.
All right. So that analysis. Thank you very much, Jose, for joining us, and thanks to the audience. And we'll see you back in February.
Absolutely. Take care, Andrew. Take care, everyone. Bye.
Thanks, everyone. Bye for now.